So there's this concept in investing, and it's called the acquirer's multiple. And the idea behind it is you want to buy stocks that are currently unpopular, stocks that have fallen out of favor with the general market sentiment. And as a result of that, they're trading at very low multiples. So you can get them very cheaply. Now, one company that I think meets this definition is Canadian Tire. Everyone's heard of this company, classic Canadian company, very strong brand equity. But the problem with them is that they are a retailer. By and large, they are a retailer. They do have an e-commerce presence, which we'll get into, but people generally see them as a retailer. And lately, in the past few years, they haven't really been growing that fast, only about 2% sales growth a year. And even more lately, so kind of in the last few months, their stock price has gotten beat down quite a bit. Now, it's not a huge decline, as we can see here. It kind of peaked in that $210 range. Now it's down to about $173. So it has come down quite a lot in the past few months. And it's not a huge decline, but it's definitely a more abnormal fluctuation for a company like Canadian Tire that is pretty mature. You don't normally see these large fluctuations in more mature companies. But what you have to understand is we're in a market right now where you have these tech companies that are 3Xing and 4Xing within a year. So I just think that boring old retail companies just are not popular investments at present time. Now, it's always important to understand that stock price does not always reflect the underlying performance of the business. There's a common quote which goes, the stock market in the long run is a weighing machine, and in the short term, it's a voting machine, meaning prices in the short term reflect just general market sentiment, what's going on in the news regarding a certain company. But in the long run, it's going to change based on the actual performance of the business and the fundamentals like revenue, earnings, and cash flow. So by buying stocks that are currently out of favor by the voting machine aspect, we can get them at relatively cheap valuations. So how we can determine this is we look at their just basic valuation metrics, price to earnings and price to cash flow here. So we can see currently price to earnings is 9.6, price to cash flow, which refers to cash flow from operations, 7.4. Both of these are below the 5-year average. And if we look at what they've been for Canadian Tire historically, it is actually quite low. So you can buy this company's earnings and their cash flow relatively cheaply compared to where it has been in the past. Now, Canadian Tire is a company that I have been following for several months now. I actually picked up one share on my own, just kind of as a tracker share, which is something that I do commonly just to kind of force a company to be top of mind. For me, if I'm thinking of building a larger position in the future, I'll just buy one tracker share. That way, kind of forces myself to keep an eye on it. And with those two metrics, you usually expect to see a stagnant or even declining company with a price to earnings and price to cash flow metric as low as that, which isn't really the case for Canadian Tire. If we go to their financial section and we take a look at how their revenue growth has been, I mean, they are growing their revenue. It's not massive growth. It's not 100% year over year like we have with some of these tech companies, but they are growing. And in the trailing 12 months, it's 16 billion, which is historically, I mean, that's pretty strong revenue growth. And even their operating income is now crossed over to the billion mark. Now, I like to look at free cash flow more than net income, just because net income can be kind of skewed by many different things that don't necessarily impact the actual operations of the company. But if we're just trying to get a high level look at the company, it is kind of represents a bit of a disconnect from what we'd expect. Usually, if you see a price to earnings below 10, that's going to be a declining company. But this is a growing company. It's not growing fast, but it is growing. And another thing that caught my eye about Canadian Tire, just when I was taking a high level look at it, is that their profit margins are actually expanding over time, not by a lot, but they are expanding. So if we look here in 2012, we can see gross margin 30.6, operating margin just under 7. And then we fast forward to today. So if we take a look at 2020, it's increased. So we got 34 gross margin and then just under 10 operating margin. And then in the trailing 12 months, their operating margin is even higher, just under 12, and their gross margin is just under 36%. So not only is the company seeing their revenue grow, but they're actually becoming more efficient overall, turning more of that revenue into actual profit. So revenue is up, profit margins are up. So why is the stock trading at historically low multiples? Well, really, it's because 2020 was an abnormally strong year for them. If we take a look at their cash flow generated from operating activities. So this is their 2020 year, $2.4 billion, and they had about $400 million in capital expenditures. So that's about $2 billion in free cash flow that they generated in 2020. Now, currently the company is about $11 billion market cap. So $2 billion free cash flow and $11 billion market cap is an absolute bargain. But it's not just like investors are asleep at the wheel. There is a reason for that, because we can see 2020, it was much lower than that. It was only about 1.1 billion in cash flow from operating activities, and call about 600, 700 billion in total free cash flow. So there is possibly a decline that investors would foresee in this company. That's because we can clearly see 2020 was a very strong year for them. They really benefited from that bump in home renovation projects that Canadians did, because obviously due to the lockdowns, people spent more time at home. People took a look around their house and said, this needs fixing or this needs fixing. So Canadian Tire benefited from that. Also, there was a huge uptick in lumber prices, again, kind of driven for the same reason. But those are both things that benefited Canadian Tire that probably won't happen into the future. It is more likely that once the lockdowns finally die down, they may return to their usual state. And if their usual state is only about 600 million or 500 million in free cash flow a year, then an $11 billion valuation does make a lot more sense for this company. It's not as much a bargain if that is what the future holds for this company. But I also think it's possible that this company may have just fallen out of favor with investors. It's not an exciting high growth tech company that's going to 3x in sales in the next year. And we've been seeing some investors get some pretty solid returns investing in those types of companies, because investing in more speculative style companies, those growth stocks over the last 18 months has proven to be very rewarding. So one obvious question we want to ask about this company is say, okay, yes, 2020, very good year for this company. Let's see how they've been doing since then. So this is in the 39 weeks ended in 2020 compared to 2021. So this will give us an idea of how they've done year over year. Now, if we look at them on a revenue basis, we can see their revenue has gone up quite a lot. It was just under 10 billion in the first 39 weeks of fiscal 2020, but now fiscal 2021, about 11.1 billion. So very strong growth there. And then on net income is more than doubled, about 340 million there to 725 $1 million there. But if we scroll down, we want to take a look at the actual cash they're generating. And it's not as great a picture if we take a look at that. So cash flow generated from operating activities, 1.6 billion in 2020, and only about 670 million in so far in 2021. So there is a little bit of uncertainty with this investment. Will they be able to continue the strong performance that they had, or even only slightly declined from their 2020 performance? Or are they going to return to how it was, say, many years ago, where they weren't making nearly as much as they did in 2020, and they just kind of generally underperform? And then the massive stock price increase that we saw kind of throughout the last 18 months just completely fizzles away, because people realize that what happened in those years is not going to continue into the future. That's kind of the uncertainty you face with this. But I do want to talk about two kind of key trends or important points to bring up about Canadian Tire that would seem to indicate that they may do okay in the future and could possibly be a bit of a bargain. Now, as with any retail-focused investment, a big risk that you face is the rise of e-commerce. If the company isn't able to adequately shift their business model to focus more on e-commerce, then it is likely that they will just be a company that isn't able to get with the times and possibly see a decline into the future. But if we take a look at this point here, they say overall e-commerce penetration rates remain about double 2019, and e-commerce sales are over 2.1 billion over a rolling 12-month basis. So over those 12 months, they did about 16 billion in revenue, and 2.1 billion of that is on their e-commerce channel. So they do have a very established e-commerce presence. It's not just like they have a small e-commerce business that they're working on developing. It's already established, it's already there, and people are clearly using it. So how we can interpret this going forward, if we're trying to build a valuation model, is say that the company's sales growth will be at least the rate of inflation. They're not going to explode in sales and grow a ton, but they're probably not going to decline as with other businesses that fail to make that transition to e-commerce, because it's already established for them. And I think it makes sense as e-commerce continues to be more prevalent in modern business that the percentage of their sales that take place on their e-commerce platform increases into the future. Now, the other point I want to bring up about Canadian Tire is this is their 2020 annual report here, is something that they've titled their operational efficiency program. And what their goal is to deliver a targeted 200 plus million in annualized savings by the year 2022. So this is essentially a boost of 200 million to the company's profit, to their free cash flow as well, by the year 2022. For a company that's worth about $11 billion right now, $200 million in an increase in free cash flow without actually having to increase their sales, just by making the company more efficient. That's a huge difference. And this could be a real game changer for the company's valuation and for how it could perform both, on a fundamental business level and in the stock market going forward into the future. Because if they are able to deliver this, that makes the company much more valuable just because they're becoming more efficient. So this is definitely something to monitor going forward to see if they are actually able to do what they're saying they're trying to do here. Okay, so with all that in mind, let's take a look at how this company has performed in the last 7 years. So revenue overall has increased at about 2.5% per year. So they're basically increasing their revenue at the rate of inflation. So the business is rather stagnant. It's not a booming business, as we know. Even with that very good boost in 2020, it didn't actually increase their sales that much. But what it did increase quite a lot was their cash flow from operations, as we can see here. Now, another thing to keep in mind is their earnings before interest and taxes has been pretty strong. It's growing at a rate of about 5.5%. So it's actually growing faster than their revenue growth. And then their net income as well, growing at 3%, so faster than their revenue growth as well. So clearly, this is a mature company. Now, if we scroll down, we take a look at their shares outstanding to see, have they been buying back shares? And they have at about 3.5% per year. So that's pretty strong. You can see they're deploying their free cash flow both to pay dividends. We can see down here, I've calculated how much of their free cash flow, so just cash from operations minus your capital expenditures, they've been paying out as a dividend. It's been pretty affordable. They're not paying out an overly excessive amount. They can definitely afford their dividend. And also they're deploying their cash flow to buy back their shares. So that's really how they're using it now: buy back some shares, but also pay some dividends, which is kind of a signal of a mature company, right? They're not really investing that much in the growth. They're not trying to achieve double-digit growth rates for the foreseeable future. Clearly, this is a mature business. So when we do a valuation, we should approach it as such. Now, I'm going to approach this valuation a little bit different than I normally do on this channel. Normally, you guys will see me use that spreadsheet that I created where I look at free cash from equity. I'm actually going to use a different method. I'm not going to explain it super in depth. It's called free cash flow to firm. In my next video that I do, which should come out either next week or the week after, I'm going to go into a full in-depth example of how to actually calculate that. And you can use it to calculate pretty much precisely how undervalued or overvalued a company's stock is. But what I'm going to do here is I have 3 cases here. I've got the low case, the middle case, and the high case. And I've also kind of attached a bit of a story to each of these cases to determine, what the numbers will look like, and then whether or not the company is undervalued or overvalued based on those targets that we put in. So the first one is Canadian Tire struggles to regain their pandemic boost. So this is the low case. This is what we don't want to see happen if we're investing in this company. We see stagnant or maybe even negative revenue growth of only about 1% a year. There's no further expansion in the growth of their earnings. So I'm using the EBIT margin here. So it was about 9.5% in the most recent years. So we don't assume that it stays at that rate. So basically their operational efficiency program is a total failure. It doesn't deliver any cost savings. And then, and this should be 2028, the terminal value is only 10 times of the 2028 free cash flow to firm, which again, I'll get into that later. And then they buy back their shares at 4% a year. So slightly higher than the 3.5% historically, just because their shares will be cheaper. Because if we're assuming the low case, we can also assume their shares are cheaper, which means they'll be able to buy back more shares. Now, the middle case is they just do okay. So only slight revenue growth, 2% a year. There are some effects of their operational efficiency program, but it's only minor. So a 9.5% EBIT margin in next year, so 2021, and then it grows slightly at 0.1% a year. So their margin does expand. And then their terminal value is 12.5 times their 2028 free cash flow. Again, that should be 2028. And their share buybacks continue at the past rate, so 3.5% a year. And then the high case is they do well. They continue to thrive. The e-commerce platform does well. Their revenue growth is 3% for the next 7 or 8 years, so actually higher than what it has been historically. The 2028 terminal value is 15 times. So that's more in line with historical averages. In these 2 cases, we assume they were a bit lower than where they've been, especially in this one, much lower than where it's been, which if investors interpret this as a dying company, then it is possible that they could foresee that. But if the company is thriving and it's growing, then it's probably going to be trading at a higher multiple. So that's why I used a higher one here of 15 times terminal value. And their 2020 operational efficiency program cost savings do continue in the future, and they have a pretty strong effect. So a 9.7 EBIT margin in 2021, which grows every year at 0.25%, and share buybacks continue at the past rate. So how does this actually look in our model here? So what you're looking at here is the actual free cash flow to firm model I built. Again, not going to go super in depth on it. I will do that in my next video. So don't worry if this is confusing. We really just want to focus on what the output of these numbers are. But I will attach this spreadsheet into the description of this video. So any of you guys that want to take a look at the calculations, feel free to do that. But this is our low case. So only 1% revenue growth. These are all the inputs here. This is the output. 9.5% EBIT margin, which doesn't change at all. It stays at that into 2028. And then our weighted average cost of capital, again, I just did a ballpark estimate of that, about 10%, which is typically what you would expect for a more mature company. Share buybacks at 4% a year, and then their 2028 terminal value quite low at only 10. So this is what we don't want to happen. This is kind of the bear case. So we can see their revenue growth, very slight, actually it'd probably be below the rate of inflation. And then we get their expected free cash flow to firm. And we're going to prorate that based on the percentage of the year. So if we're buying the stock now, we only have a little bit of 2021 left. And then we get the discounted value. So this is all discounted. All these numbers here discounted at 10% a year, which includes the terminal value. So this can kind of help you understand why cash flows that are generated this year, next year, year after that, short-term cash flows are worth a lot more than cash flows generated 10 years out, because you discount them. So like cash flow, for example, of about $1 billion that we expect in the year 2028 for Canadian Tire, its present value, if we discount it at 10%, is only pretty much half of that, 500 million. So that's really why companies that generate cash flows so far out in the future are worth much less, and why you have to be careful speculating on those types of companies, just because of it's worth so much less when you discount it. So let's focus on these these bolded numbers down here. Intrinsic value per share. If we get the value of their operating assets, which is literally just the sum of all that, we add the cash and marketable securities. We take out the debt, which I just did a ballpark estimate. We'll assume it's $7 billion in 2028. We get the market value of their equity, divided that by the number of shares outstanding we expect to have, which decreases by 4% a year under this assumption. Intrinsic value is only 122. So not exactly what we'd want. I mean, that would tell us that it's not undervalued at all. So let's change it up and put in our middle case assumptions. So we're boosting up our revenue growth, 2%. EBIT will start at 9.5%, but then we assume it grows at 0.1% a year. We keep the weighted average cost of capital the same. This now changes to 3.5% because their shares are more expensive. So the money that they have can't buy back as many shares. And then this, because the business outlook is a bit better, we'd expect a higher terminal value multiple, 12.5, which is still actually quite conservative. So under those assumptions, the company is undervalued, just under 5%. So these are very mid-level assumptions. I would be very comfortable assuming that Canadian Tire could hit these numbers. And this would basically tell us that this company would probably outperform the market over the next 8 years. Again, it's not a guarantee, but based on these assumptions we put in, just with a very standard weighted average cost of capital at 10%, which is what discounts these expected future cash flows we have here, overall, the company's probably going to do okay. Now let's put in our high case. This is what you want to see happen. This is much more positive outlook for the company. So the revenue grows at 3% a year. EBIT margin starts at 9.7% for 2021, and then it grows at 0.25. So that operational efficiency program they talked about, it's able to deliver very strong, cost savings into the future. And then the terminal value is a higher multiple. Again, because the business outlook is positive. We are expecting them to do better, kind of the terminal value, which is supposed to capture all the cash flows that the company generates from 2028 onwards. So basically 2028 till the end of time. So we put that at 15, 38% undervalued. That is pretty strong. That indicates a pretty significant buying opportunity there. So how do we interpret this? Well, let's look back at the assumptions. If you believe the high case is true, then buy this company, because clearly they're most likely going to do pretty well. And because their stock price has gone down from where it was a few months ago, about 210 to under 175 now, it's gotten so much cheaper, which makes it a more attractive buy. You're paying a lower price for this future stream of cash flows here. But under the middle case, as we saw, they're still undervalued in that scenario. So what you're doing is you're putting yourself in a situation where you don't need Canadian Tire to just knock it out of the park, blow away like all the investors' highest expectations in order to earn a decent return. This is in contrast to investing in these speculative tech companies. Even a company that's so strong as Shopify, in order for you to earn a decent return holding Shopify into the long run, they have to do amazing. They have excellence priced into their valuation. I mean, if Shopify shows any blip in their revenue growth numbers, it is possible that you could see your investment decline pretty significantly. Now, obviously, Shopify is an amazing company, but who knows what the future will hold for them. But with Canadian Tire, you're putting yourself in a scenario where you don't need them to knock it out of the park to do just okay on your investment. If they hit these middle case numbers, then you're probably going to do okay. And again, this relates to the whole acquirers multiple idea, because the company right now has just fallen out of favor, right? And they may have fallen out of favor for good reason. Maybe there are some legitimate concerns that there are with this business, but just based on what we know about the past and what, a few things we looked at, the operational efficiency program, growth in e-commerce sales, I personally don't think that's the case. And I would expect this company to do pretty well going into the future. And I would even lean more heavily towards this high case here. Again, that's just my opinion. Always do your own research and don't just buy stocks based on my opinion alone. But that's just how I felt looking at this company. But anyways, guys, that does it for the look at Canadian Tire. So I hope you did find this useful. If you did find it useful, then please leave the video a like and subscribe if you're new to the channel and you like this types of content. I do have plenty more videos like this one planned. And with that in mind, I'll see you in the next one.